Although Chapter 13 on standard costing is not particularly long, it's a good scene setter for understanding standard costing and bringing together a lot of the topics that we've already seen before we start to have a look at how we can control our organisation and start to think about how we can evaluate performance. This topic then is examinable in Section A and Section B. So in the chapter we'll be looking at what we mean by standard costing and the presentation of that information in what we call a cost card, which is a bit like a recipe for production. We're also going to be thinking about how businesses will actually set standards and how they will use it. So I've mentioned that one of the uses will be control, but we'll also see how it can be used for other areas of the business. One of the main uses then is a flexible budget, and we'll be looking at how we can compare what should have happened with what did happen and use our flexible budget for what-if analysis. Before we start preparing standard cost cards, let's have a look at what we mean by a standard cost. Well, it's basically an expectation of what management think it's going to cost for producing a product. In addition to production, we could have standards for other items, such as standard production times or standard repair times. We could also have standards for things like punctuality on trains. So I think there's an expectation that it would be great if 100% of trains were on time, but actually that's not likely to happen. So we'll have a target for how many should. And this is just a couple of examples. I'm sure, as you can imagine, the list is endless. Management then will work out their standard cost or their standard time in advance. And the standard cost then is a little bit like a recipe because it's what you think it should take and what you should be using in order to make a unit. And within our standard costs, we'll be thinking about how long it should take the labour and also thinking about efficiency in terms of materials. So perhaps if it's expected that there will be some wastage, that will be built into the standard. We'll also be looking at the expected price of those materials, those ingredients, and any labour and expenses. And we'll also be thinking about any overhead costs. And what we're going to do then is have a standard cost for each product that the company is manufacturing. And we'll see an example of one of these in a moment. In Worked Example 1, we have a standard cost card, and we can see then that the expectation here is that there will be 4 kilograms of material used, and it will cost $3 per kilogram, meaning that there's a total cost of $12 for the material. And this is obviously if things go according to plan. Then for labour, we've got the same kind of idea. 3 hours at $10 gives us our $30. So the direct cost, also known as the prime cost, will be $42 per unit. And we've also got some variable overheads then. So the variable cost of producing the product is $46.50. And that is the production cost of 1 unit under marginal costing, because that is the extra cost to produce 1 extra unit. However, if we're looking at absorption costing, remember with absorption costing, we're looking at the full production cost, which means we need to add in some fixed overheads. And here we're absorbing fixed overheads at the rate of $4.50 per hour, and it appears to be based on labour hours. So that takes the standard cost under absorption costing to $60. What this means then is that management thinks that the cost of producing 1 extra unit is $46.50. That could be useful for short-term decisions, such as if you have spare capacity and want to decide if you should make an extra unit. But for the longer term, the standard cost is $60. So if we want to cover all of our costs, then we know that they are $60 per unit if things go according to plan. So there are 4 different types then of standards that we could calculate, and these standards then are based upon the assumptions made about the operating conditions. The 4 standards then are the ideal standards, the current standard, the basic standard, and the expected. Let's start off then with ideal. This is based then on perfect conditions, so there not being any wastage or idle time. It can represent a very difficult target to achieve, and this is often demotivating because you can't do this. So recently I decided to get fit and to start running. If my trainer had said to me then, well, it's possible to run a mile in 4 minutes, Roger Bannister did it, so off you go, and that will mean that you can run a marathon in just over 100 minutes. If the trainer set me a target then of a 4-minute mile, that would be demotivating for me because I'm no Olympic athlete and I know that I wouldn't be able to achieve that. The next one then is a current standard. Here then we're basing our targets on what we can do at the moment. So that includes any inefficiencies that exist at the moment. The problem with a current standard is that there's no improvement in the future because you're just trying to stick at what you've got. So if on my first training session then I was able to run a mile in 10 minutes, then setting a standard of 10 minutes is just maintaining the status quo and isn't going to improve my fitness. For a business, it would mean it wouldn't improve efficiency and reduce costs. The basic standards then are when we don't alter them, so they're sometimes known as historical standards. So often these then are very out of date because there have been changes in performance. So how fast I could run when I was doing cross country at school isn't particularly relevant to today. Lots of changes, lots more cake since then. Long-term standards though, or historic standards, are useful if we want to see what improvements there have been over time. Finally then we've got the most useful, which is the expected standards. So here we've got some improvement, so something that we can aim for, so perhaps me being able to run my mile in 9 minutes, but we're not looking for perfection. We're looking for what is practically possible, because the idea then is that should motivate you because you know that they can be achieved. So we should be achieving goal congruence. So the uses then for standard costing, one of the things then is for the budgets, for decision making. If you know how much materials you need for 1 unit, if you're planning to make 1,000 units, you can make sure that you've got the resources and you've got the inventory available to do that. So we can use it to decide what we're going to make and then set the budget. We can also use it as a control technique where we're going to have a look at what actually happened compared to what we thought was going to happen. And that's something called variance analysis that we'll be looking at in the next chapter. Performance evaluation is a bit more than just variances. We're looking then at setting our standards to motivate our staff, but also to assess results perhaps of the company or the division. And as well as being used internally, external investors will also evaluate the performance. Inventory valuation, if we have a standard value for a unit of finished goods, it's much easier than basing it on average. It's also less time consuming than using something like FIFO or weighted average. We can use then standard costing, as I said, to perform variance analysis where we're looking at comparing our budgeted cost with our actual costs. As with many techniques then, there are advantages and disadvantages of setting standards. We've mentioned the usage, and it does definitely help the budget. If you've got a realistic estimate per unit, then that should manifest itself into a much better and much more accurate budget. It means as well that we should be assessing performance based on some realistic targets, which should motivate staff. We can also use our standards cost to set the price, because we can just add a profit margin to the costs, and that will ensure that we're profitable. And because we can use it for valuation of inventory, it makes bookkeeping simpler. The problem with standard setting is in so many areas we don't have a crystal ball, and this is no exception, and it can be very difficult to forecast accurately. It's also time consuming, which means that we are using up management accounting time that could perhaps be used elsewhere, perhaps making strategic decisions. For our standards to be meaningful, they have to be regularly revised and based on current expectations, because it's motivating if they're right, but it's demotivating if the targets are incorrect, because employees might stop trying if they know they're not going to be able to achieve them. The other thing with standard costing is that if we start with what we can already do and look for improvements for that, inefficiencies can already be built in. Businesses then need to work out an overhead absorption rate per unit, and we've already seen this when we're looking at producing the full cost of a unit. So when we're accounting for overheads, we said that we could allocate our overheads on a per unit basis. What we need to realise then is that businesses who are using these overhead absorption rates need to know how much it costs before production commences. And so we're going to use what's known as a predetermined overhead absorption rate. Now, this is the formula that we've seen before. We're looking at the overhead cost divided by the activity. The difference here is that we are now saying that this needs to be budgeted overheads and budgeted activity. And by activity, we're referring to the number of units that we're going to produce, because that's what we're going to share the overheads over. So that's the bit that we've seen before. What we're doing now then is we're going to take that overhead absorption rate per unit, and we're going to look at how much overhead is absorbed. So we're going to multiply our overhead absorption rate by the actual level of activity. So if we based our overhead absorption rate on labour hours, we'll multiply the OAR by the actual labour hours, and that will give us the amount of fixed overhead which is absorbed into the profit and loss account. However, at the end of the year, we will need to compare our overheads that we've absorbed with the actual overheads that have been incurred. And it's very unlikely that the two figures will be the same. And that could be because expenditure was different, so we might have spent more or less than we planned to, or volume was different, so we might have produced more or less units than we were expecting to. And if it's expenditure that's different, then that is what's known as an expenditure variance. But if it's the number of units, that's a volume variance. And we'll see more about how to deal with those two and calculate the variances later on. But what we're concerned with at the moment is the difference between the overhead that's been absorbed, i.e. the OAR times by the actual activity, and the actual overheads. That difference is over or under absorption. So just to recap then, the actual overhead will be the value of the invoices. So at the end of the period, when all of the bills come in and we see how much we've spent, that will be the actual overheads. The overhead absorbed will be in the accounts, and that is basically, imagine somebody is sat in the corner of the factory, and every time labour works an hour, they're there with a tally chart absorbing the amount of overhead per labour hour. So what you end up with in your income statement is the overhead absorbed and an adjustment for under or over absorption. and the net of those two will always come back to the overhead that has actually been incurred, because in the accounts then at the end of the year you want the value of the invoices to be there because that's what it's actually cost you. But that will be shown then as overheads absorbed plus an adjustment. And we'll look at variances later, but as I said, we can break down our adjustment for under or over absorption into an expenditure variance and a volume variance. And we've got the formula there for the volume variance and the expenditure variance, but we'll come back to those in chapter 14. They're here though because when you're revising and you've studied variances, it's very useful to know how everything is going to fit together. So what we have in lecture example 1 is some information which is very standard for a section A question. So we've got the budgeted figures, what we thought was going to happen, and then we've got the actual figures. And we can see that the number of units produced was different from budget to actual, as were the amount of overheads that were incurred. So what we need to do now then is to work out the under or over absorption, and we're breaking that down into different stages so you can see the process. So the predetermined overhead absorption rate then is always based upon the budgeted figures. So we've got $100,000 and we were planning to make 20,000 units. So the overhead absorption rate is going to be $5 per unit. The amount of overhead absorbed for the period then will be taking that OAR of $5 per unit and multiplying it by actual production. So for every single unit that was manufactured, there will be $5 allocated to the income statement. So we're going to end up with $120,000 in our income statement. Actually though, overheads were only $117,000. So that means that we have got $3,000 too much overheads. So what we've got is what we call over absorption. So we've got over absorption because we've absorbed 3,000 too much. And if we showed that in our income statement, we would show our fixed overheads absorbed of 120,000, and then we'd show our adjustment for over absorption of 3,000. And the net of those two figures is the 117,000, which is what we've actually spent on overheads. So although we don't show the 117,000, you can see that it's all there. Referring back to some terminology that we considered previously, remember the master budget is all of the different statements and it's prepared before the accounting period begins. And it's all based on our budgeted volumes, costs and revenues. The flex budget then is an extension of that, but our flexible budget is designed to change as the number of units produced changes. And the way that it changes then will depend upon whether the costs are fixed or variable. So if we've got fixed costs, they will be the same within a given range, but variable costs will need to change. Flexible budgets then, sometimes known as what-if budgets, are very useful so that we end up with a budget that is meaningful, because what we do is we end up with an amount that tells us how much it should have cost given the number of units that we've produced, and we can use that for variance analysis purposes. It's also useful upfront at planning if we want to know what happens if. What happens if we make more units? What happens if we make fewer units? And with this kind of what-if analysis, we might use a spreadsheet to help us see all of the different possible profit outcomes. From a control point of view, as I mentioned, we can compare our results with budget and produce variances as a result of our calculations. So variances then are basically the differences between our budgeted results and our actual results. And if you have a look here, then we've got WCO and we've got the results for June. And we've got the budget compared to the actual results. And you can see if you look down at the bottom that we've got a favourable, so that's good news, that's what the F denotes, variance on profit of 4,900. So initially then it looks very good because profits then have been higher than were expected, and that's because sales were more than expected. However, all of the costs were going to be more than expected as well. And we want to understand though why these variances are meaningless, so why what we've prepared is meaningless. Well, the reason that it's meaningless is because of the production levels. We've made 50% more units than we were planning to, so it's expected then that our costs would be higher because actually we've produced more units, but it's also expected that our revenue would be higher. So what we don't know then in this extra profit of 4,900, how much is down to the extra units being produced and how much is down to operating efficiency. So what we need to do is actually to identify the different types of costs and revenues, and we need to flex them according to their nature to work out what our budgeted cost allowance would have been if we'd planned to make 3,000 units rather than 2,000. So what we'll end up with is a statement which says how much should it have cost us for 3,000 compared to how much did it cost us for 3,000, and that will give us much more meaningful variances. To do this then we'll need to have information about cost behaviour, which we've got at the bottom of the page. So let's just summarise then the correct approach for comparing results. Well, we'll need to identify which costs are fixed and which are variable from the additional information so that we can prepare a flexible budget based on the actual activity level. So here we'll look at what it should cost to make 3,000 units, and we'll compare that to what it did cost to make those 3,000 units, and that will give us our variances. So materials, labour and maintenance costs then are all variable, so we would expect those to increase in line with the number of units produced. However, rent, rates and depreciation are fixed costs, so they should actually be constant regardless of the number of units produced. And then other costs is mixed. It's got an element of fixed cost and an element of variable cost.
What we can see in this page is a much more meaningful statement. You can see in this statement that we have the original fixed budget based on the 2,000 units. But now we have a flexed budget based on the 3,000 units. And what that flexed budget will show us is what it should have cost to make 3,000 units. We can then compare that to column C, which is the actual results, to get much more meaningful information on the variance, where we're going to compare those actual results not to the original fixed budget, but now to the flexed budget. So we can look and see what it actually cost us to make the 3,000 units compared to what it should have cost us to make the 3,000 units, and therefore given management much more meaningful information on the variance. Okay, so if we look at sales revenue, we can see that the fixed budget was expecting to have sales revenue of $20,000, and that was based on selling 2,000 units, so therefore $10 per unit, or 20,000 divided by our 2,000 units. If we look at the flex budget, we'll see the flex budget is now based on selling the 3,000 units. So if we take the 3,000 units in the flex budget and multiply it by the $10 per unit, we can see that we have a flex budget of $30,000 for sales revenue. So that's what we would expect to get from selling 3,000 units. If we now compare that to what we actually got from selling 3,000 units, we can see that we actually got 30,000 also, so therefore we've still obtained that selling price of $10 per unit, and therefore there has been no variance in relation to sales revenue. So what we received from selling 3,000 units, was what we would expect to get from selling 3,000 units. There was no change in the selling price. Okay, if we look now at variable costs, obviously the variable costs, we would expect them to change as the number of units change. So if you look, we can see that we can calculate the per unit variable cost for direct materials, direct labour and maintenance. So based on the original budget of 2,000 units, we had direct materials of 6,000, therefore working out that we would have a direct material cost per unit of 3. If we take that $3 per unit and flex it for the 3,000 units that we actually produced, we can see that 3,000 multiplied by $3 per unit would give us an expected cost of $9,000. So to produce 3,000 units, we would expect that to cost us $9,000. If we look and see what did it actually cost us, well, it actually cost us $8,500. So therefore we've done well, we've managed to save $500 in direct material costs, therefore resulting in a favourable variance. And we can do that for each of the other categories of variable costs. So we can see direct labour is $2 per unit, flexing up for the budget of 3,000 units, we would expect a cost of 6,000. We didn't. We only had a cost of 4,500, so again another favourable variance. It's cost us less than we expected it to. And finally, with maintenance, $0.5 per unit. So multiplying that by the 3,000 units, we would expect a maintenance cost of $1,500. We didn't, we had $1,400, so again, another favourable variance. Okay, if we look at other costs we've seen from the previous page at the start of the example were made up partly by fixed costs. A fixed element, just reminded you over here, of $1,600 was included in other costs. And therefore the variable cost, again as we've seen previously, was made up of $1 per unit. Okay, and we can see that that's reflected in the original budget. So the original budget was based on 2,000 units, so therefore the fixed element was 1,600, the variable was 2,000. And if we flex that for our flex budget of 3,000, we would see that we would expect to have semi-variable costs of 4,600. We didn't, we had semi-variable costs of 5,000, so this time we've actually spent more than we expected to, therefore resulting in an adverse variance. Okay, if we look at our fixed costs finally, we can see that we would not expect our fixed costs to change with the number of units produced. So you can now see that the original fixed budget is identical to the flexed budget, so we wouldn't change those fixed costs for a change in the number of units produced, they would stay constant. So now if we compare our actual results to the budget, we can see that we actually had depreciation of 2,200 compared to a budget of 2,000, so therefore an adverse variance of 200. And finally, we actually had renting rates of 1,600, again resulting in an adverse variance of 100. Okay, so if we look to summarise the position, we can see that we still have the original $4,900 favourable total variance that we had on the previous page. But now we can see that that's broken down into much more meaningful information for management. So we know that that 4,900 favourable variance was partly due to the volume. So in other words, the fact that we produced more units than we originally anticipated. And obviously a company that does produce or increase their production by 50%, they would expect to make more profit. And that has happened. We've made $3,500 of additional profit purely due to the fact that we've produced additional units. And that's our volume variance. But what management can also identify now is that part of the overall total variance is due to efficiency within the business. So we've managed to generate cost savings overall of $1,400. And that $1,400 we call our expenditure variance, and as I said, that's due to efficiencies within the company. So that can be used for management performance and appraisal, and obviously the management involved in this department could be credited with the success of that efficiency variance.
In lecture example 2 then, we've got 3 different flexible budgets that were drawn up. So at the start of the period, we now know what it should have cost for 10,000, 12,000 and 14,000 units. What we want to know though is what our cost allowance should have been if 12,350 units were produced. So what we need to do then is to have a look at which costs are fixed, which are variable, and which, if any, are mixed. Now, if you look at the cost allowance then for the different number of units, you can see that the overhead is fixed. It's 20,000 regardless of the number of units being produced. So we can just pop that 20,000 in there because 12,350 is going to sit within that range of experience. If you look at the material costs, you can see as well that those are constant. So 30 divided by 10 is $3 per unit, 36 divided by 12 is $3 per unit, and 42,000 divided by 14 is $3 per unit as well. So it's a good idea then to work out the cost per unit at all of the different activities, and if it's the same, then you know it's constant. So $3 per unit, and we're going to be made 12,350 units. So materials should have cost us $37,050. Now if we look at the labour costs then, we can see that for 10,000 units it's $270 per unit, and for 12,000 units it's $258. So it's not constant and it's not variable, so therefore it's a mixed cost. What that means then is that we need to identify the variable cost element and the fixed cost element. And the way that we're going to do that is through the high-low method. So when we made 14,000 units, labour was $35,000, and when we made 10,000 units, labour was $27,000. So to make an extra 4,000 units, how much extra did it cost? What's the difference between those two cost elements? So it's going to be an extra $8,000 to make an extra 4,000 units. So the variable cost per unit is going to be $2. We also need to know the fixed cost. So the total cost for 10,000 units was $27,000. The variable cost for 10,000 at $2 each is $20,000. So that means that the fixed element is $7,000. So we've got variable costs of $2 per unit and fixed costs of $7,000. We want a cost allowance for 12,350 units. So the variable cost element is going to be 24,700 plus the fixed cost element of 7,000. So our labour allowance will be 31,700. And if we look back at the original table, that will be in line with our expectations because we're making just over 12,000 units and the labour cost was 31,000 for 12,000 units. So we'd expect it to be slightly higher. So if we add all of that up, we get a total of 88,750. Now you may have noticed that the high-low technique could actually have been applied to the totals. So if you were just looking at the total flex cost and you didn't have to break it down, you could have used the high-low method across all of the costs and you would have got the same answer. But if you're required to break it down and analyse it line by line, then you need to take the approach we've shown in the question. Using the high-low method across all of the overheads might be a useful shortcut in the exam though. We could also face a knowledge style question or a discursive question about a flexible budget. So let's just have a look in example 3 at this one. So which of the following describes aspects of a flexible budget? A budget comprising variable production costs only. It's the word only that makes that incorrect because it does include variable production costs, but those aren't the only cost. A budget which is updated with actual costs and revenues as they occur during the period of the budget, well, that's not going to be the case here. That's more what we call a rolling budget if we're going to update our assumptions as they occur. A budget which shows the costs and revenues at different levels of activity, well, that's pretty much a textbook definition of flexible budgeting. But let's just check the final one. A sales revenue budget which is changed to reflect the actual unit sales price. Again, that one is incorrect. So the correct answer here is C. In summary then, in this chapter, we've looked at what we mean by standards. So standard then is preparing in advance what you think it's going to cost in the future. So it's a predetermined estimate of what it's going to cost for making one unit. And we use that then when we're valuing our inventory and when we are making assumptions for our budget. And we saw there are 4 different types of standards: the ideal, the current, the basic, and the expected. And the most useful one for encouraging our staff to work hard to encourage goal congruence is the expected standard. Standards themselves then can be used to control performance as well as to set budgets through variance analysis. And one of the things that you'll do then is by having a look at under or over absorption. So under absorption occurring when we haven't got enough fixed overhead absorbed into the profit and loss account, and over absorption when we've got too much, i.e. the amount absorbed is greater than the value of the invoices. Flexible budgets then are a technique that we use to compare meaningfully the costs at the actual level of activity with how much it should have cost at that level of activity. So flexible budgets then are budgets which are restated to be based on actual production volumes.